Welcome to the Sandbox presentation on the use of factors for analysis and investing, featuring Milind Sharma, founder of QuantZ, located in New York. The Sandbox portal, www.sigmasandbox.com, hosts data such as hedge funds, ETFs, indices, benchmarks, mutual funds, and now the 18 files of monthly returns of QuantZ's investable equity factors. Sandbox provides a set of interactive tools to examine this data and allow users to combine and construct portfolios on the fly and compare them to, again, indices, ETFs, and hedge funds. Milind will be using the Sandbox app for this analysis. A limited version of this app is available to advisors and accredited investors free of charge. Milind has 24 years of market experience. If anybody doesn't know who he is, I think everybody does know who Milind is, spanning the running of prop desks at RBC and Deutsche Bank, as well as running QuantZ's hedge fund and mutual funds, as well as his fintech venture, QMIT, QMIT. His funds have won many awards over the years from Morningstar, Lipper, Wall Street Journal, Battle of the Quants. He was also co-founder of Quant Strategies at MLIM, it's now BlackRock, and he was manager of risk analytics and research at Ernst & Young, where he was co-architect of Raven. He's got dual degrees in computational finance and math, and he's also in the logic PhD program at Carnegie Mellon. He's a founder of Quaff-A-Few New, which is the former Quaff-A-Few, and we're pleased to have Milind as a guest today and feature a discussion of equity factors and QuantZ's take on the subject. Over to you, Milind.
Well, thank you so much for the kind introduction, David. Always a pleasure and a privilege to join you in Sigma. So yeah, I mean, we're really excited about having our 31 signals, including the smart betas and the combo sort of hedge fund, proxy signals or turnkey offering, if you will, on your platform, so that your advisor community can see the full 20-year history and play with it as we get into that part of the demo. But why don't I start by just introducing the basic concepts behind factor investing and where we're headed with all of this. So allow me to share my screen. All right, let's see if that works. Okay, how is that? Can you see the presentation, Dave?
I can, yes.
Okay, fantastic. All right. So let's talk a little bit about factor investing and going from smart betas to smart alphas and sort of constructing the signals that we're here to talk about today using Sigma Sandbox. As many of you know, this all started with the single index model in CAPM, and over time, what was yesterday's alpha became beta, and progressively with Fama French and so on, and the hundreds of anomalies being documented in the literature. A lot of what used to be perceived to be alpha is increasingly becoming commoditized beta. The good news is that if one goes about doing this in a very systematic manner, which we've attempted to with 600 plus factors, and then combine them into these smart betas, in theory, one should be able to, with these sort of machine learning enhanced cohorts and the enhanced smart betas, one should be able to express really any view on equities. That's our overarching claim, and that allows you to effectively express the same kind of views on in the quant space, or actually in the fundamental space in general, quantamentally speaking, like the shows and the two sigmas the world used to before. So we're trying to democratize access to those hedge fund alphas. How do we do that? Well, this is just sort of setting the stage for the basic definitions. I mean, all right, so we've got hundreds of these factors, and what we're going to do is we're going to turn them into 18 of these smart beta composites. There's kind of the analogous sector neutral composites, which we won't talk about. And then there's a bit of detail that that's beneath the cover in terms of how the machine learning ensembles work. And I'm going to gloss over these details. They're not terribly important. But the idea is that, whereas one may have a simple P or PB type of notion, kind of like the high minus low in Fama French, what we're doing here is actually taking lots of different approaches, whether that's maximizing Sharpe or risk parity or something else, or it could even be random forest and XG boost. But we're combining this sort of ensemble of learners to get a better version of all the things that you know, like growth, value, momentum, etc. And we just kind of track, you know, the best stocks by each of these composites, which are built out of these hundreds of factors, and then we track the best ones against the worst ones on a market neutral basis, and that's what each smart beta constitutes. So each of these 18 on the left here, like deep value, relative value, etc., are going to be, you know, that market neutral construct of the best names on price to book versus the worst names in price to book, combined with a whole bunch of other metrics like maybe enterprise to this and EBITDA to that, or, you know, free cash flow yield, all those types of things. And then the idea is that if we did a good job of sort of optimally constructing these machine learning enhanced smart betas, then just pushing them together into equal weighted composites may actually give us very powerful hedge fund signals. And that's what we're going to see once we get to the demo with Dave. But bear with me for a moment. Why do we go to all of this trouble, you might ask? Why care about hundreds of factors? And the simple reason is that, you know, not all factors are created equal. Just like, you know, you have dispersion within managers in a given category, that tends to be much dispersion between different factors within the same category. And here we demonstrate that for momentum, for instance, the better known versions of momentum, like 12-month price momentum, you know, the old sort of Jagdish Titman paper from 1992, on the left here, not the greatest distributional characteristics. You have some nasty left tail kind of crashes here, the momentum crashes, which we know happen often. And then on the right side are kind of the more enhanced versions that we play with, that we've created, which allow us to dramatically enhance the cohorts. So in general, the idea is for every one of these smart betas, we got some bad factors, some good factors. Hopefully we can combine them in a way that allows us to overweight the better ones. All right, does that work? Well, let's take a look. So in this case, we're demonstrating for you the full history of now 20.5 years through June 30th. And you can see on a beta neutral basis, if you take something like cap usage and cap structure, which is this quality bucket down here. So in this quality cohort, you can see that actually, if you just take something simple like cash to market over or cash to assets over 20 years, doesn't do much. In fact, it's negative. So it's giving you a minus 2% return over 20.5 years. Whereas if we just equal weight them, we do a lot better, 10%. However, if we do something else, like, you know, for instance, take the best 3 on a Sharpe basis over time and just consider those, we do better, up to almost 13. And then if we just take the top 3 winners on a return basis and keep rebalancing those, it gets us to 15 and change. So it's a pretty dramatic 17% pickup there. Now, same thing in the case of ROE, that if you do this fancy footwork, it turns out that a simple ROE factor itself does pretty fine, 10% annualized, but, you know, with this, we more than double the returns to 22 and change. And that's generally the idea for all of the 18 smart betas, which you can see here in a descending order, that over time, we're able to add some pretty dramatic value compared to a naive benchmark just by doing this sort of machine learning ensemble. So as you can see here, things like profitability over time, very juicy, 22.3 annualized return with 1.3 Sharpe for Sortino. Leverage, which has all these sort of, you know, debt to equity type of credit related metrics embedded in it, over for Sortino. And then over here on the other side, I also show you the long only returns if you're a long only investor. And, you know, there are categories where we don't add much value, like dividends or short interest. They work well on the long side. You get 9 or 11% there, but dividends or short interest, you don't do too well long short, because the short side sort of gets in the way. So this is high level what's going on. We just show you the Sharpe and the Sortinos in descending order, and you can see that actually they're pretty compelling for most of these. Where it does work, it works really well. And let's now fast forward to what's going on today and sort of, you know, draw the connection with recent market events. So you can see this year in particular, viewed through our risk on, risk off kind of regime-based lens, this whole sort of regime-based factor investing paradigm has been enormously successful, because the risk-off factors, the defensive ones, have worked extremely well, as you would expect in Q1. So profitability up 31% year to date. Things like cap structure up single digits. Enhanced momentum, classic. Enhanced momentum up 46% now on the year. Stability, earnings stability, revenues, all those type of metrics combined together, 20%. Analyst revisions and all the stuff that goes with that, whether it's diffusion metrics, et cetera. So all the things that you'd logically expect to work are actually working. I'll get to reversals in just a moment, which is a proxy for the stat arb hedge fund universe. We can also sort of stare at the long-term results once we get into, but here you can see in descending order, the longer term sort of, it turns out the best ones are deep value, relative value, et cetera, which have done very poorly recently. You can see actually this year, deep value is down 26%, but longer term, it's annualizing the highest number, 19.2. And we'll see that, and again, in a moment in the Sandbox platform. But I just want to comment on the combos here. So you can see that just doing some basic combinations can get you pretty far. So this year, for instance, on a year-to-date basis, you can see growth plus momentum gets you up to 32. Obviously, anything with value in it is not doing too well this year. So that's generally the idea. It turns out one can also get a nice sector rotation model out of this. We don't need to touch on that really. You can look at all the returns correlations or cross-sectional correlations, which we'll see in the software. And I want to just wrap up this part of the intro with this regime-based lens, because this really shows you what causes a lot of confusion, because oftentimes you hear very confusing sort of one size sort of, fits all type of narrative in the media that, oh, quants blew up in March or quants blew up again in April. Well, actually, what they're doing is they're averaging across all the factors, hundreds of them, or these composites, and not recognizing that if you look at it the right way, it actually worked pretty well. So throughout the crash episode from Feb 19th till the Fed stepped in on March 23rd, you can see during that decline, all the risk-off factors on the left here, with the exception of dividends. As I mentioned, in dividends, we're shorting half the universe, which don't pay dividends. That's why it doesn't work so well. But pretty much everything on the left here in risk-off did well, exceptionally well. In fact, his low vol up 40% market neutral, profitability 20%, stability. So clearly the defensive factors delivered. Conversely, the risk on offensive factors like deep value and efficiency, reversals, et cetera, didn't. So this spread between the on and off, kind of, if you were to think about it as your factor tilts, actually did extremely well, over 22% in this time period of roughly 1 month. And then if we look forward to April, May, and the remainder of Q2, and we notice how things reversed pretty dramatically. Why? Because of the tsunami of liquidity from the Fed and all the other fiscal stimulus. So basically all of the risk-off factors in the lighter gray bars that were up in March, subsequently from March 24th till the end of the quarter actually reversed pretty dramatically, and you can see they go down then, whereas the risk-on factors actually flip sign, and you can see reversals in particular did extremely well, over, basically doubled as a result of that whole sort of phenomenon. And so I'm going to skip to this chart and then conclude. But basically, if you look at the right side here in the risk on, in March, the green line, which represents stat arb funds and sort of the mean reversion trade, was plummeting pretty dramatically. It was down actually as much as 40% at one point, and then it picks up. Well, actually it was down 40% dollar neutral, not beta neutral. That's why you don't see it down quite as much here. But then that's because in the early days of the crash, you were kind of catching the falling knives, and as that reverts and the stimulus kicks in, all the beaten down junk really starts to rally pretty hard, and you see that we go from roughly minus 30-40% plus 70, and so that's how you got the over 100% return there. So with that, I'll hand it back to Dave so he can introduce the platform.
Great. Thanks, Milind. Bear with me a second here. Thank you, Milind. Can you hear me there?
Yes.
Okay. Can you see the screen, by the way? The sandbox screen. You can?
Looks nice, yeah.
Okay, great. Okay. Thank you very much, Milind. That was fantastic. Just a little update on Sandbox. Sandbox was built to allow investors to examine their portfolios and look for how their portfolios might be correlated to a variety of investment vehicles, and help them possibly construct better portfolios using a fair amount of data that we have available, and in real time examine the substitution effect, both of indices, alternatives, ETFs, and mutual funds. Just going to spend a couple of minutes just walking through this, what data is available. We have a hedge fund catalog. We have a catalog from CASA, the Canadian Alternative Investment Association. We have an ETF catalog, Milind's factor catalog, a mutual fund catalog, and Milind's, and rather an index catalog. This is delivered primarily from Refinitiv. These are benchmarks that are available for users of the platform to select. And as a user, one can basically bookmark from this fairly large catalog of indices, bookmark their favorites, and then as they wish, they can drag and drop, in this case, indices over and build benchmarks. I'm just building a random series of equity benchmarks. And the system will basically make a calculation of, this is just a random series of portfolios. Some involve Milind's equity factors. And by the way, the red line is the computed average of essentially this random group of investments we allocate. One can amend, change, alter this portfolio. One can increase leverage, and as one increases exposure, say to the S&P 500, one can see distributions change. One can see statistics change over there. And if one comes across a portfolio of ETFs and indices and hedge funds that they like, the investor then has the ability to be able to save that. Next time they come back again, that portfolio is saved, and an infinite number of portfolios can be saved and to be re-examined as new data comes in. And then also benchmark their favorites, because for instance, on ETFs, there may be 800 or 900 ETFs. It helps to be able to benchmark your favorites. And that's just a very brief sort of summary of Sandbox. It's meant to be very interactive. It's meant to be very quick. It's definitely a front office tool. It's not a back office, a middle office, or administrative tool. It is a tool to help in portfolio construction and to understand correlations very, very, very quickly. And Milind will go into that a bit more with his indices and how he examines correlations very closely and uses that in a very significant way to get a more robust portfolio of factors. So Milind, that's what can I do for you now?
Well, I'm really impressed, Dave, that you're on a DSL line and still able to run these queries so quickly. That speaks to your software. So, really quite a wealth of information between factors and ETFs and all the various categories of indices and hedge funds that you've got there, which are going to be pretty handy as we try to play with some of our smart betas. So why don't we grab a couple of these, you've got growth, mom, and quality and value.
Okay.
value composite, maybe we can throw them into correlation builder and see if,
Okay.
you know,
So,
I mean, the simple intuition is that one expects value and growth to be less correlated, and same for
sure.
momentum
Let's
or,
look at value and growth.
yeah.
So here we've got the growth factor, and here obviously the value composite is stunningly different.
Yeah, it's
Um,
really catching up with growth.
absolutely, just gotta wait. Absolutely. So and the correlations are here, and those correlations are calculated on the fly. That's calculating on the fly correlations of 20 years of monthly returns.
Right.
Um,
Yeah,
what else?
you see the negative 39 as we expected, right? So it's a pretty negative number. And if you throw in qual, we should see something similar, namely that, so qual is going to be positive to value, which we expect, but it should be flat or negative to growth mom, which we also expect. And by the way, our growth composite includes price momentum as well as earnings momentum. So it's a much broader construct, and the value composite includes both deep value and relative value. And the quality actually includes 6 of our basic smart betas that relate to quality, everything from earnings quality to leverage and liquidity and that structure. And so there's actually a lot going on beneath the surface, but the correlations describe the high level picture well. What if we is that good enough, I guess, to demonstrate the concept?
Sure. Well, we can, if you have any others here, these are the factors we're maintaining for Quant Z, and these factors are available for users to come in and play with. Examine for correlation, examine for if they're factors that they wish to, what's the return of this combination of factors equally weighted. These are 3 factors here: GROMO, ValComp, and your quality composite. This is the historical risk and return numbers associated with an equal weighting. By the way, if you can see, I don't know if you can see that dark red line, that is an average of the 3 equally weighted factors. And of course, if you increase those, you can see Sharpe will change, drawdown will change. If you wanted to, I guess the green is the composite, and you can see everything changes on the fly. It allows people to have an intuitive understanding of the impact of adjusting these for themselves, or integrating these factors into their overall portfolio for in some kind of a completion program rather. So yeah, so these are all the factors we have. Milind, if there are any others you'd like to see or like to compare it to?
I mean, if you want to harp on the negative correlations, we could throw in the reversals just to demonstrate what we were talking about earlier. So
Very good, very good. Yeah. So
reversal.
let me find the reversals here. Here they are. Okay, I'm going to bookmark those over here. So then I'll just drag this one over, reversals. And which is the reversal would be the
sort of standard mean reversion. So again, you've got negative correlations in general, or at least pretty flat to negative. It's plus a little bit plus on value, but negative to growth momentum, which kind of makes sense, right? I mean, if momentum growth is trend following in an equity sense, then reversals mean reversion is going to be negative to that. So you get the minus 0.25. Flat to negative against quality, but yeah, you see the big pop lately, which has to do with, I showed in my slides earlier how StatArb has done very well since March, April, generating over 100% return. So that's the spike that you see.
right. Extraordinary.
Yeah. But your portfolio builder is a very handy tool because the slider really lets you play around with the different combinations, right? And
absolutely,
it's really neat to see, for the advisor to see the overall returns distribution changing, the skew and the kurtosis, and the and the mu and sigma and Sharpe and drawdown. So that's a pretty handy feature for building intuition. Now it turns out that our combo signals are doing something very similar to this, right? So when we take one of our composites like the Sizzling 7, for instance. That's kind of what it's trying to do, is to combine a bunch of the well-known factors together. It has a few extra ones like short interest related, and it's got reversals, which you have, as well as value and momentum and qual, etc. Um, now, there's some other technicalities that actually fully integrates them, and so kind of takes the intersection set of them, not just the linear combination. But putting aside these subtleties, I mean, high level, if you're just combining a portfolio of the factors, if you will, think of them as ETFs, right? Or some basket that you can invest. Then combining these the portfolio of these factors should look somewhat similar to Sizzling 7. And so maybe you want to throw in Sizzling 7 and see how that compares.
For sure. Let's look at correlations here. So Sizzling 7 down across the bottom.
Yeah. So
that has sizzled.
Yeah, but so a couple of things going on here. First of all, notice how high the correlation is to the constituents, right? Like, because obviously value is 0.65. That's because value happens to be roughly a sixth or a fifth of the total constituent, right, of Sizzling 7. And then quality is also a very high number, 0.67. No surprise there. Reversals 0.36. Actually, the one I'm a little surprised by is growth mom being flat. That's I would have expected that to be higher, but high level, it does sort of make sense. And the discrepancy you see between the sort of, when we go to the portfolio builder, the average of the constituent factors, right, which is your dark red line, I guess.
Yes.
That portfolio, the difference between that dark red and this purple, the Sizzling 7, really speaks to the technicality I was hinting at, which is that if you just combine a bunch of good names from different factors, they may cancel out to a large extent. That's what's going on. So that's why that portfolio of opposites is not as strong as taking the intersection set, right? Because this portfolio of opposites is kind of the union of those names, whereas my purple line, the Sizzling 7, is kind of the intersection of the high conviction names where, each of the factors is reinforcing itself. And the stocks where they cancel each other out are actually not being held. That's why it does so much better over time.
The one thing that is interesting is that one could use this, take one or two of your factors at a time, and drag ETFs across.
That's right.
And find correlations that may be very interesting. We're going to be building out a capability of having the system search ETFs for correlations to your factors, which will be very interesting. But on their own, investors can go and drag 5 or 10 across and drag an intersect in one of your factors, and it will examine the correlations and push out the relevant information. I guess factors can be used in many ways, as well as just completion investments, structures on their own, and also a very interesting tool to analyze other investments as well.
I mean, one of the neat features, by the way, which I'm sure, David, you had in mind when you built this, is that your system is so powerful that once you throw in the returns of, let's say, some famous managers like Bill Miller or Warren Buffett, right? A cool feature would be to take any famous manager, take our constituent factors, right, and see how much of their returns you could explain with our smart betas. And I bet you, if you take Buffett against our Q-Val, you could probably explain a bunch of his returns based on our quality plus value, et cetera, right? So that type of analysis can be also very insightful.
Absolutely. I certainly know Warren Buffett has been bemoaning his recent performance. And there it is. Nothing. He's a great investor, but value has been out of favor for sure. As this shows. Fantastic.
Now, You mentioned sort of replication and that sort of stuff. A very powerful concept, just based on simple correlations or PCAs, those type of things. One of the other simpler but really powerful models we've found that people tend to really find interesting is our LBO signal, where we try to
Yes.
uh, anticipate stocks. Is this a good segue, or what do you think?
Sure, absolutely, absolutely. So should I take these out, remove these, or just
As you
bring
wish.
LBO across? Hmm?
We yeah, we could, if you want to see the correlation of the LBO, you can throw it in and then
For
remove
sure.
the
Let's do that for sure.
actually might give us some insights.
I
Uh,
will throw Gromo back in, and let's look at the correlations of these. So again, going across the second line from the bottom, there's the LBO.
yeah, so it's pretty interesting. It's high on value, right? That's exactly what you'd expect. It's got a smattering of value, and it's got a bunch of quality in it, even reversals. Who would have thunk? It actually does seem to load a bit at sizzling 7, which is a combo, so not that, but it's negative to growth momentum. So actually, if you think about the simple logic of LBOs, what kind of companies are likely to get LBO'd out by the private equity firms or strategic buyers? I mean, actually, that makes a lot of sense because they're usually the underperforming stocks, hence the negative
Sure.
correlation to growth momentum. Whereas, they're turnaround candidates, right? So they're going to be high on deep value, and usually they'll have quality. And so that's exactly what you're seeing. That makes a lot of sense.
For
Um,
sure. And you can see in merger arb managers, event-driven managers, how are they correlated to this factor? Very interesting. I think it is.
You could throw out those composites and put in a merger arb index or something. And now it's interesting because the LBO only tries to anticipate before the announcement, whereas merger arb are playing the spread post the announcement. So they may actually turn
Right.
out very uncorrelated. At least
That's
that's
a
what.
good point.
Um,
That's a good point. Yeah, most merger arb is post announcement for sure.
yeah.
Much merger arb.
So
Very,
one
very
one important detail here, Dave, is that we're taking actually in the LBO strategy, we're taking our top 100 predictions for names that would fit as LBO candidates with no other constraints. There's no risk or sector factor controls at all. That's maybe at the portfolio construction step once you want to decide how much you want to bet on individual names. But the easiest sort of thing one can do to hedge out the risk, which unhedged, it's very high vol but very high return.
Yep.
It's like 24 vol, but if you hedge it by the small cap value index, which is Russell 2000 value, turns out that the total vol collapses to 1/3. So from 24, you get down to 8% vol on this LBO strategy with roughly 12, 13 returns, which I think if you were to pull up the top sheet, one could see that. So we're actually showing the net market neutral kind of returns for that strategy here.
For sure. Yeah.
Yeah.
And by the way, for every factor and also for every investment, the Sandbox generates this top sheet. So these are the details of the LBO strategy, for instance, and describes what Milind just mentioned, and very well concisely put together. So it's a very good, if someone wants to come in and examine this, not only do you have these factors, but you have a description of what each factor is, and you get a PDF, if you will, of Milind's data, and you can see ValComp, what it's done over the last few years. And of course, then if you want to see how it plays with the other ones, you go to the portfolio builder itself. But everything we have here actually does have top sheet capability. So whether you click on any ETF or any factor, you can obviously find out what ETFs are invested in. It's a fairly all-encompassing little tool for advisors and investors to use. Milind, thank you. I really appreciate you coming on and talking about how an investor institution can use your signals and possibly build product out of it. I think it's very enlightening and I think very, very useful and very timely.
Well, such a pleasure and privilege to be joining your platform, Dave. Thank you for giving us the the shelf space in your portal. Appreciate it.
My pleasure.